Hi, I'm Linda Eedes, and this is an update on the RECM Global Fund, looking specifically at the third quarter of this year. So again, it was a great quarter for equities around the globe. The US and the Eurozone and the UK were all up quite strongly over the quarter, and that was buoyed by sort of signs of economic growth, economic activity, rising metal prices, which also boosted emerging markets most of all, interestingly enough. And the Global Fund participated very much so in this. And the reason for that is that the fund is orientated, first of all, towards a lot of businesses which derive revenue from emerging markets or are actually based in emerging markets themselves. I think the important sort of caveat there is that they have to be high quality businesses, and in many cases the businesses that we're finding are really businesses that have grown out of family owned businesses in many respects, that are really trading at attractive prices because they're being overlooked in favor of the sort of headline grabbing stocks of the day, which of course includes all the sort of global tech giants. So stocks that did well in the portfolio over the quarter included Tesco. The sterling actually appreciated over the quarter, and that was good for a lot of the domestic UK businesses such as Tesco. Of course, the converse happened in South Africa, where we actually saw the rand weakening, and that was of course slightly negative for the sort of more domestically focused South African equities, whilst the rand hedge stocks, the big sort of global South African businesses like Naspers and Richemont, actually did very well. Emerging markets, as I mentioned, were very strong. We saw metal prices rising, and that sort of had a very positive boost on some of the resources exposure that we still have in the fund. We have increasingly pulled that back over time, as you all know, as those stocks have rallied. And if you actually look at resources as a whole, over the last sort of year and a half, since the beginning of 2016, the resources index as a whole is up about 60% in US dollar terms. So you would of course expect us to be sort of reducing that exposure quite significantly as that comes through. But of course for the quarter, it was very positive for the Global Fund, and the Global Fund returned 8% versus its benchmark, which is an inflation-based benchmark, which was a sort of around 1.5%, which is of course inflation plus 6%, US inflation. Other businesses in the fund which performed very well during the quarter were businesses that have more financial exposure. That was on the back of sort of expectations of rising interest rates, and in particular Berkshire Hathaway, which is the second largest position in the fund now, actually was up quite strongly as a result of their insurance exposure, with there being obviously a positive correlation between the fortunes of particularly long-term insurers and of course interest rates rising. Energy prices were slightly up. That was really sort of fueled by the signs of economic activity, as well as a little bit of disruption in the Gulf of Mexico with regards to supply. So we saw a couple of the energy stocks in the portfolio, such as Inpex and BP, starting to have some life and coming through in the quarter as well. In terms of stocks that were either flat or slightly down during the quarter, Coach, the US retailer, has actually done incredibly well over the last sort of year and a half, but over the last quarter they sort of retraced a little bit, the market not really loving the fact that they're going to rename the business at the overall level Tapestry, very much though in line with a lot of luxury goods companies like Richemont, like LVMH, which have a number of brands under one umbrella. So they will still retain their core brands at the sort of underlying level, namely Coach, Stuart Weitzman and Kate Spade. You will probably remember that the fund has quite a bit of cash still in the portfolio. About 25% of the fund is still in cash. I think that's completely appropriate given where sort of valuations sit at the overall market level. You would expect to have a bit of cash in the portfolio because high quality, undervalued businesses are a little bit hard to come by at the moment. But that cash is not sitting in US dollars, which we believe is a little bit rich. If you look at inflation differentials or purchasing power parity, the dollar does look a bit expensive relative to most other currencies. And we're holding that cash in a combination of sterling and the other half split between yen and euros, and that exposure outside of the US dollar, which weakened during the quarter, was also a boost to the Global Fund's returns. So within the Global Fund, we continue to find some really nice ideas in good businesses in various sort of geographies, industries, different investment ideas, and that's of course what you want. 2 years ago, the sort of main opportunity amongst sort of value was really the resource stocks. We obviously did participate in that, but it came with a lot of volatility associated with that price volatility. And what we found is over the last 2 years, that opportunity set has widened out quite considerably, and we're finding finding lots of very interesting businesses, particularly amongst the financials and industrials, moving sort of slightly away from the resource kind of oriented businesses. And what's good about that is that it results in a portfolio that's more diversified than it was, which is of course what you prefer. And also the actual overall quality of the portfolio has also increased. Of course, resources, by virtue of their cyclicality and the volatility associated with that, are lower quality than sort of a good business which has actually been able to sort of consistently beat the market in terms of the earnings that they've generated, and which sort of has obviously grown its sort of intrinsic value over time. So I want to highlight 3 new stocks which we've introduced into the portfolio over the quarter. And interestingly enough, all 3 of them happen to be in the retail space in one shape or form, but in quite different sort of areas and also sort of different geographies, as it turns out as well. So the first of these is a company by the name of Williams-Sonoma. They're actually a US luxury homeware retailer. So they have brands which you may be familiar with, such as Pottery Barn in the US. That's obviously one of their sort of main brands, and then they also do go under the name of Williams-Sonoma as well. And that is a phenomenal business, which is actually sort of a world leader in terms of omni-channel sales, if you like, and they've been able to grow a significant presence online. So in actual fact, more than half of their revenue is derived from online sales. And this business has also been impacted by the fact that the consumer has been under a little bit of pressure more recently, and that has had a bit of a knock-on effect on sort of all retailers. But what it's done is it's provided us with the opportunity to buy a phenomenal business, a business which has a track record of sort of returning in excess of 18% returns on equity over cost of equity, and you're buying it currently at a 3.5% dividend yield on a PE of around 13, which for a business of this quality is an absolute bargain. The next business that we have also introduced into the portfolio in the retail space happens to be in the UK. In fact, the other 2 retailers both are in the UK, but in very separate markets. The one is Carpetright, which provides flooring, and the other one is Next, which of course is clothing, both on the high street and also online as well. They happen to be the biggest retailers in both of those spaces in the UK. So it's no coincidence really that quite a few new investment ideas are coming out of the UK. Obviously, that is a region that has quite a bit of uncertainty attached to it at the moment because of Brexit, the impact that that will ultimately have on businesses there, and then sort of the direct knock-on effect of the weakness in the pound, which was obviously caused by all of this. Now, the pound actually strengthened a little bit over the last quarter, but if you look at how it's valued in terms of purchasing power parity, we actually think it's still undervalued and that there's still room for the pound to strengthen further. But looking at those 2 businesses, Carpetright is a big sort of provider of flooring, particularly carpeting in the UK. They've got almost a third of the market share there. They've really sort of historically been able to use that very much to their advantage in terms of sort of their bargaining power, their economies of scale. They've had access to cheaper sourcing. They've had access to cheaper long-term leases. And it's been through quite a difficult time over the last few years. And when we look at that business fundamentally, we still think that that sort of market share advantage really stands them in good sense to actually sort of see through the cycle and recover with that turn in the cycle, as well as a lot that they're doing sort of within the business to kind of refocus their efforts. Next is sort of a dominant clothing retail in the UK. As I mentioned, they've got the biggest market share both online and in the high street. And that business has also obviously come under a bit of pressure because of the consumer sort of experiencing zero real wage growth and the like. So that business has had a little bit of a knock-on effect there. And really, you're again buying a great business at an attractive price because the market really sort of generally does not look through the cycle. It sort of looks at how a business is doing today, and then it kind of extrapolates that into the future and says that that will be the case forever after. All 3 of these businesses have intrinsics which really mean that they will be best positioned to take advantage of the cycle as it recovers and sort of plays through. So looking at how the portfolio is positioned at the overall level, as I mentioned, the portfolio does still have a little bit of cash. I think that's a comfortable position to be in. It does provide us with that dry powder to sort of allocate to new investment ideas, as sort of a lot of kind of nervous and kind of jittery investors perhaps do sell some of the stocks that we want to hold. We're really looking for those good businesses which are in many cases just being ignored in favor of stuff that is just a lot more kind of current, a lot more hyped up. And there I'm obviously talking about, this whole sort of orientation towards global tech giants. That really is dragging the whole market in a particular direction, and it's opening up a lot of opportunity to pick up businesses which perhaps aren't in the US, which perhaps have some sort of revenue coming from emerging markets, which are perhaps in emerging Europe, which are sort of not your big high quality defensives, which are the businesses that have perhaps been through a bit of a difficult time over the last few years, but which now really are poised to do very well from this point onwards. So increasingly you'll see the portfolio moving away from what would typically be the sort of makeup of something like the MSCI All Countries World Index, which is kind of half of that is in the US. On just about any valuation measure that you look at, the US is looking overvalued. There are a lot of kind of commentators justifying why that is okay and why businesses should be valued much higher now than they would have been historically. But it just sounds eerily similar to the whole "this time it's different" that we've heard in prior sort of top of bull markets. I think one wants to be oriented away from the market. One wants to have some dry powder to actually buy great businesses when those businesses do become attractive. But really a well-diversified portfolio which is not participating in the hype is how you want to be positioned, and that's exactly how the RECM Global Fund is positioned today.